Welcome back to the Deep Dive. Today we are opening up the financial engine room of a business to look at something that, let's be honest, often gets filed away under dull accounting. We're talking about cash budgeting.
But if you listen to one thing about finance this year, this should be it. This
Uh-huh.
isn't dull at all. I'd say it's
Yeah.
the ultimate map for corporate survival.
A map, I like that.
Well, we're diving into financial forecasting because the whole point of this data is to shift management from being reactive, chasing money, panicking when the bank account gets low,
Right, to being proactive.
to being fundamentally proactive. That's the goal.
And that's the mission for us today. We want to move past the traditional income statement. I mean, that statement tells you if you're profitable, which is great, but profit is really just an idea on paper.
It is.
We need to focus on liquidity instead. How and when actual cash, real money moves in and out of the business.
Because here's the most critical, kind of counterintuitive truth in business. You can be wildly profitable, your books can look fantastic, and you can still run out of money.
Just because the timing is off?
Just because the timing of your cash coming in and cash going out is off by a few weeks, it can trigger a severe liquidity crisis.
And the cash budget is the tool, maybe the only tool, that gives you that warning weeks or even months ahead of time. It lets you act before the well runs dry.
Precisely. So let's start building that map. We'll start with the first half. Forecasting cash outflows. If we want to survive, we need to know not just what we owe, but when that cash is physically going to leave the account.
Okay, let's unpack this. Our source material gives us a nice three-step framework for forecasting cash disbursements, specifically for inventory payments.
Right.
Step one is making the link between sales and purchases. So for most companies, you assume inventory levels stay pretty constant. If that's the case, then your purchases have to equal your cost of goods sold, or COGS.
And just for a quick refresher, COGS is the direct cost of the stuff you sold. It's the material cost, not overhead or anything like that.
Exactly. And this company gives us a really reliable number to work with. Historically, their COGS is 80% of sales.
And that 80% rule is the key. It's the mathematical foundation for everything that comes next.
So let's use the data. They forecast December sales at a very healthy $200,000.
A great month.
So we apply that 80% rule, and your inventory purchases for December must be $160,000.
Right. And that's the amount of inventory you bought that month, not what you paid for yet.
That's the important distinction.
Mm.
Okay, so that leads to step two, which is where things get a bit more complex.
This is where the strategy comes in. Applying the specific payment pattern. This company, like many, uses credit. They pay for their purchases over time.
And their pattern is very specific. They pay 50% in the month after the purchase.
And the other 50% in the second month after the purchase.
This lag, I mean, this is the whole ball game, isn't it?
It is. You're essentially paying for past success, for inventory you stockpiled weeks or months ago, not what you're selling today. And that delay is what creates the potential for these massive timing problems.
So let's see it in action. Step three, building the actual budget.
Right.
We need to map out where the cash disbursements are actually coming from.
Let's use January as our example.
Okay, so looking at the table in our source, the total cash payment for inventory in January is $120,000. That's a huge number.
A huge number. And to see the risk, we have to figure out which purchases that 120 is actually for.
So we have to look backwards, right? Because of that 50-50 rule.
2 months back. January's big payment is funded by buying activity from 2 previous months.
Okay, walk me through that. Where does the first piece of that money come from?
The first source is November's purchases. Let's say November purchases were $80,000.
Okay.
January is the second month after November. So the company pays the second 50% chunk of that $80,000 purchase. That's $40,000.
Got it. That's the really delayed payment finally hitting the books. So the second source must be from December.
Exactly. December's purchases were that big 160 figure we just calculated.
Right, the 160,000.
And January is the first month after December, so they pay the first 50% of that, which is $80,000.
So you add them up. 40,000 from November's purchase plus 80,000 from December's purchase. And that's our total January payment, $120,000.
And there it is. What this shows is that December was a month of massive buying, but the cash cost for that success doesn't actually hit the company until January and February.
This is what you meant by strategic planning. It's not just a summary. It's forecasting the exact moment the cash is going to vanish.
Yes. And here's where it gets really important for you, the listener. We're now going to integrate these outflows with the cash coming in the collections to build the complete cash budget.
This is where we find the cash trap.
Exactly. This is where we see the critical timing mismatch that can sink an otherwise successful business. So let's look at the forecast for January, February, and March.
Okay, January looks pretty good. Cash collections are strong at over 138,000. Disbursements were that 120,000 we calculated.
Right.
So that gives them a comfortable positive net cash flow of over $18,000.
Things are fine. Cumulative cash is healthy. The manager feels great.
But then February hits.
And this is the crisis moment. Collections just plummet to around 90,000. But critically, the cash disbursements, the outflows, stay stubbornly high at that same $120,000.
So the result is
What?
a catastrophic net cash flow. It's negative $29,000 for 1 month.
Ouch.
Yeah, ouch is right. It completely wipes out the gain from January and leaves the company with a cumulative cash shortfall of over $10,000.
They're in the hole. They haven't planned for this. They're bouncing checks. They're panicking.
And then just as fast, it recovers. March comes along, and net cash flow is positive again, way up by over $40,000. The cumulative cash is back in the black.
This volatility is the silent killer.
So wait, let's unpack the why here. If December was so profitable, why is that very profitability punishing the company 2 months later?
That's the structural problem. February had the lowest sales forecast of the period, only $50,000.
So cash collections, the money coming in, were naturally low.
Very low. But at the same time, they were saddled with these enormous payments, that $120,000, because they were still paying for the massive inventory they bought back in December to support those big sales.
So they were profitable, but only on paper. The profitability required this huge cash outflow for inventory, and that outflow happened before the customer cash came back in.
And there you have it. High profitability in December can directly lead to a liquidity crisis in February. It's all about managing the timing.
You can just picture the two different managers in this scenario. The reactive one is sitting there in mid-February just watching the bank balance drain to zero.
Stressed out, scrambling, making calls.
And the proactive manager. They saw this coming on January 1st. They saw that negative 29,000 on their forecast, and they are calm. They're ready.
They've already arranged financing. That advance notice completely changes the options available to you.
Which is fascinating because the budget itself then dictates these very specific, concrete actions. It's not abstract.
Not at all. First, because you know the precise shortfall, you can arrange financing. You walk into the bank in January with this detailed budget,
Right.
and you get a short-term loan for February. You can even show them the proof of how you'll repay it in March.
Okay, what if you don't want to borrow?
Then you can negotiate with suppliers. You proactively call them in January and ask to delay some of that February payment. You keep the relationship strong because you're not surprising them.
And the third option would be on the other side of the ledger.
Accelerate collections.
Yeah.
Exactly. You get the sales team to push for earlier payments from customers. Maybe you offer a small discount just to pull that future cash into the critical February window. None of this is even possible without the cash budget.
This level of detail, it goes beyond just inventory payments too. We have to talk about a really critical nuance. Non-cash outflows. This is a huge trap.
Oh, this is where people who only look at the income statement get burned. Not every expense is actual cash leaving the business.
Let's use the Winthrop example from the sources. They had total budgeted expenses of $1.2 million.
Right. And if you just use that number for your cash planning, you are overstating your cash needs.
Because hidden inside that total is an expense called depreciation. $37,500 worth.
And depreciation is just an accounting entry. It's recognizing the wear and tear on a machine or a computer over time.
Yeah.
The cash for that asset left the building years ago when they bought it. No check is being written today.
So to get the true, accurate cash outflow, you absolutely have to subtract that non-cash expense.
It's a simple calculation. $1.2 million in total expenses minus the $37,500 in depreciation.
Which gives you the real cash outflow number, $1,162,500.
And if you fail to make that adjustment, you incorrectly think you need almost $40,000 more in cash than you actually do. It's a major error.
This kind of precision is so important because the ultimate goal here is to figure out exactly how much money, if any, you need to borrow to maintain a safe cash balance.
And we can see this formula play out perfectly in the raster graphics example. They start with a net cash flow before financing of negative $25,000.
Right. They already know they're running a cash deficit for the month.
But every company also needs a minimum cash reserve, a safety margin. For raster graphics, that target is $21,000. They need to end the month with at least that much in the bank.
So let's track it. They start the month with $35,000 in cash. You subtract that $25,000 shortfall.
Which means without borrowing, they'd end the month with only $10,000.
They need 21, but they're on track to have only 10. The math is clear.
They need to borrow exactly $11,000 to hit that minimum target. That is the tactical takeaway from the entire exercise, the exact borrowing requirement.
And finally, it's really crucial to remember that the simple 50-50 payment pattern we used earlier is just an example.
It's not universal. You have to use your own company's specific historical data. Business reality is always more complex.
The Kimball scenario shows this perfectly. Their payments are split across 3 months, 40% in the month of purchase.
50% the next month, and then a final 10% in the second month after purchase.
Why would they do that?
It often happens when a company pays a big chunk up front to get a supplier discount. They're sacrificing a little immediate cash for a better overall price.
And if you use that unique pattern, the calculation for March looks completely different.
Totally different. So for Kimball's March payment, you have to pull from 3 sources. First, 40% of March's purchases. That's $60,000.
Okay, then the second piece.
50% of February's purchases. That's another $60,000.
And then the last little bit.
The final 10% of January's purchases, that's $10,000.
So 60 plus 60 plus 10. That's a total March payment of $130,000.
Exactly. And if you had wrongly used that simple 50-50 rule, your calculation would have been way off. You would have completely underestimated your need for cash in March.
Which just reinforces the main principle. The cash budget has to be a customized instrument. It's not a template.
Absolutely. I think this deep dive really shows that, right, they're desperate. But when you can present a detailed, proactive cash budget, showing the bank that you already saw the problem coming, you calculated the exact solution, and you know exactly when you'll pay them back.
It instantly makes you look organized, credible,
and low risk.
So here's the thought we want to leave you with today. How does that increased credibility actually impact your bottom line? A lender who trusts your forecast, who sees you're on top of this timing mismatch, is probably going to offer you better loan terms.
Maybe even lower interest rates. That cash budget doesn't just save you from running out of money, it actively makes the money you borrowed cheaper, which increases your profitability in the long run.